Welcome to Motley Fool Money. Thanks for being here. I'm your host, Chris Hill. Joining me in studio this week from Motley Fool One, Jason Moser, from Motley Fool Income Investor, James Early, and from Motley Fool Asset Management, Tim Hanson. Good to see you guys.
Good to see you, Chris.
Hey there.
Always good to see you.
We have got some big deals this week in the consumer goods industry, the entertainment industry. We will break those down. We'll dig into some more earnings news. And as always, we've got a few stocks on our radar. But let's start with maybe the biggest deal of the week. Berkshire Hathaway and 3G Capital are buying Heinz for $23 billion in cash. Shares of Heinz were at an all-time high, James, and Warren Buffett felt compelled to pay a 19% premium on that. So my first question is, did he pay too much?
Well, it depends, Chris. I mean, I'm happy as an income investor advisor because I recommended Heinz, and now it's up 20%. And we finally got a chance to see what Warren Buffett's elephant gun looks like, which is pretty cool too. But this deal to me smacks more of okayness than genius. The fuzz factor, to answer your question, is going to be how much fat these 3G guys can trim, who are going to come in and manage this company, can trim from this business. Heinz has been cutting costs for many years, so I don't know how effective that's going to be. I don't think it'll be a disaster. I just don't see it being a huge success either.
What about you, Tim?
Well, this is another one of those deals that only Buffett could get. I mean, the way it's being financed is he's getting some preferred shares that are going to pay, I think, a 9% dividend, which is, in an era of
That's nice.
zero interest rate,
it's
right?
not too bad.
I mean, that's a way to put a lot of money to work at a market, probably a market beating rate. So I think it probably works out well for him. He's got some equity to share on the upside if 3G can cut costs like they did at Anheuser-Busch. But it does look at first blush to be a little bit expensive, especially because, I think Heinz is on the wrong side of where the food trends in this country and to some extent globally are going, which is more fresh, type foods, and they're heavy into the canned and prepackaged and pasteurized type.
You're
things.
saying tater tots are not fresh?
I mean,
It's debatable.
They're delicious.
I don't know. Are they?
Sure. Who doesn't love tater tots?
I'm not a big tater tot fan. I mean, there's probably going to be some mail that comes in about this, but I think tater tots are overrated.
I was in Quebec, and my son had just turned 1. I needed baby food. I bought all this Heinz baby food, and he wasn't eating it. I realized tomato paste was the number one ingredient in every single thing.
James, when you look at Berkshire Hathaway stock, it is trading at an all-time high, even after this deal, which tells me that, some people think, well, you know what, it's Buffett, and we're going to trust him. What do you think of the shares?
Buffett is always going to get the benefit of the doubt. I mean, my concern, I think, is legitimate. He's not going to live forever, and what's going to happen? I mean, it's just, I wouldn't be a buyer now, just for that reason.
Comcast, as of the beginning of the week, owned 51% of NBC Universal, and apparently, Jason, they liked it so much they decided to buy the remaining 49% from GE for the tidy sum of $16.7 billion. And similar to what I just said about Berkshire, I think people think this is a great deal because both stocks were at multi-year highs in the wake of this deal.
Yeah, I think on the surface of it, it's a good deal for Comcast. I mean, in this age of cheap money, it's not like it was a surprise they were going to do this. They just kind of sped up the timeline. But it gives them, it makes them a little bit more vertical, gives them a little bit more control over content in an age where content costs are going up. But they still also benefit from the cable and the network side with generating higher affiliate fees. I think not to get lost in this is the benefit for GE because ultimately they're going to get out of a business that I don't think they really had any business being in to begin with. And you look at the stock over the past 5 years, and GE has woefully underperformed the market. And this is going to give them a chance. I mean, their focus is their intention to return $18 billion this coming year to shareholders in the form of buybacks and dividends. So, if you're a shareholder of GE the last 5 years, this has got to at least be encouraging news.
Woefully is always a good word to work in.
It is. It's really bad.
Well, and to that point, Jeff Immelt, the CEO over at GE, really seems to be executing on this plan of focusing the company a little bit more and really getting away from the days where GE Capital was the main driving force for that company.
Yeah, and it makes you kind of think of that Peter Lynchian term, diversification, right? I mean, when companies just start going so far out of their circle of competence that it really just makes the collective business worse. And I think that GE had probably gotten to that point. So hopefully this will get them a little bit more focused.
GE Capital was more of an accident, right? I mean, people just couldn't afford refrigerators a long time ago. So it just started financing those appliance purchases, and it just grew and grew and grew. It's kind of interesting.
The proverbial happy accident. Tim, we also saw a bunch of other content deals. I mean, this was the biggest this week, but we saw Starz and Sony Pictures, Amazon working out a deal with DreamWorks Animation, Amazon and CBS. They all sort of came in this flurry, and it just seems like this the battle for the living room that we talk about from time to time is just getting more and more amped up as everyone is looking for a dance partner when it comes to content.
I think that's true, and I think it raises two questions to think about going forward. The first is, why aren't these people who are creating why are they so eager to license when in fact they could probably be thinking about distribution on their own, and that might be more profitable for them. Instead of yielding to Apple, for example, your entire song catalog and let them make money on the hardware and the software and the network effects and the ecosystem competitive advantage, why not do something like that on your own? I think that's one good question that these content companies should be asking themselves. And the second is, when does Google and Apple and these companies, when do they start coming after sports? Right now ESPN is notoriously, a Disney unit, owns the rights to most major sports broadcasts, and they pay a lot for it. But if, Apple has a TV in the works and they want to bid for the Super Bowl, that could get really interesting because they have a lot of money, and that would be a really powerful form of content that has not yet gone into play in this area.
Yeah, I think Tim keys in on something very important there with sports, and Comcast did just sign a deal with Fox. Sort of, it's in that TV everywhere strategy, and soccer was included there. So I think at least that's a small step toward that direction. So I wouldn't be surprised to see maybe a little bit more of a focus there going forward, because that really is cutting the cord is a great headline and all, but most people aren't cutting the cord because sports is such a tether there.
But networks are not as necessary as they used to be, which I think is Tim's point.
Absolutely.
That's interesting.
Jason, what do you think of Comcast, the stock? Because this is a company that, as often as not, shows up in the news for, being one of those big companies that does not have great reputations with customers, and yet now it seems like, just from a business standpoint, they're really kicking a lot of ass.
Yeah, the business performs very well. Historically, it's done very well. Going forward, it's a little bit more questionable, though, because the landscape is changing so quickly with digital distribution and streaming and your other concepts out there like Netflix, and who knows what Apple's going to be doing here, or Google to a degree. So I think going forward, it's a little bit less clear, but for sure, the company to this point, it generates a lot of cash and really has a lot of hold over their subscribers.
I do think you need to be careful as a long-term investor in buying shares of companies whose customers would probably think life is better off without them.
Right.
And this refers to like the Verizons of the world, the Comcast. I'm a Comcast customer out of necessity. If I could do a la carte cable, or if sports were available via the App Store, I would unsubscribe from Comcast very, very quickly. And so I think that's always a specter hanging over the stock.
U.S. Airways and AMR, the parent company of American Airlines, have agreed to an $11 billion merger that will result in the largest airline in the world. And Tim, contrary to the previous deals, it seems like people weren't psyched about this. Shares of U.S. Air were down, so apparently bigger is not better.
Well, these are also, I think, generally regarded as being two of the weaker airlines in the U.S. market, and that's particularly true of American with their labor troubles, and they've had big problems. And being a weaker part of an airline industry in the U.S., that's saying something, right? That's a low bar. Airlines are famously horrible investments, especially in the United States. The joke is, how do you become an airline millionaire? You start with $1 billion and buy an airline.
Yeah.
But the industry is rationalizing. I think we're now down to 3 hub and spoke carriers after United and Continental merged, and now you've got the American and U.S. Airlines merger. People are still traveling a lot. At some point, these companies they have to start making money, right, Chris? Am I wrong about that?
I don't know. It does seem like one of the potential ripple effects is maybe a benefit for JetBlue and Southwest and the smaller ones, because of the size of this airline, they're going to have to. The regulators are probably going to force them to give up some terminal space.
You probably do get some more gates if you're looking for them. If you're Southwest, for example, But like I said, travel has been a constant. Even during the recession, people kept traveling, and obviously they traded down a little bit on cost. But people like to travel, and it's going to be a much more rational industry going forward over the next 10 years. It looks like than it was over the past 10.
American Express announced a partnership with Twitter that would allow cardholders to buy things simply by typing a hashtag on Twitter. And Jason, you're shareholder. You're a card holder of
Yeah.
American Express.
Yeah,
You've
not a
already tried
shareholder.
this.
I did try, yeah. Well, I've tried it in two capacities. The first was 6 months ago or so when they initially were allowing you to just retweet something and actually benefit from a deal. So it was a coupon going to a restaurant. But
Yep.
I didn't actually have to present a coupon. I just used my Amex, and then the next day they deducted the $20 off the card. This is you can actually purchase things if you just include the hashtag and then the verbiage of the deal there. And I tried it with their initial $25 gift card, and apparently they had just run out, so I kind of missed the boat on that one. But I've seen a lot of tweets go through my Twitter feed today from Amex. They are pushing a lot of these Kindles and Sony PlayStation devices. So, yeah, I mean, I think that they are recognizing the fact that e-commerce and social networking go very well together, and it's just a matter of how to make it work best. And, honestly, this is something where I like a Twitter more than I like a Facebook, because I think Twitter has really more or less solved that mobile barrier already, because the platform really just works with mobile, whereas Facebook is really trying to overcome that mobile barrier still. And so I think it's potentially Facebook could probably be taking a few notes from this.
Let me just make sure I understand. So you get the deal if you retweet the deal to a bunch of your friends?
But no, he didn't get the deal because they just run out.
No, it's two
Oh,
separate
just
things.
run out.
That's the
deal,
card dealer model.
The deal is you retweet. But
Okay.
if you want to buy something, this is the new one. Is
Okay,
if you
I
want
see.
to buy
That's a
something,
different
you
one. Okay.
actually tweet the hashtag with the deal after the hashtag, and
But
then
you
would
still have to
actually,
spam your friends, basically.
I guess that's a
It's
good
kind of like
point.
impairing the friendship to a minor degree for money, though. They're asking you to
Potentially,
do.
that's
Yeah.
assuming that the people following you on our Twitter are actually your friends.
Good point.
Tim, you seem skeptical of this whole scenario.
It is what it is. I think companies will be rewarded for experimenting with these media because there are lots of people using them. I don't think anyone has figured out how to effectively market to them. As James said, there's a really fine line between, intrusion into the life of a customer and their friends. And Facebook, I think, is managing this really poorly because unlike Twitter, where your followers ostensibly are not necessarily all your friends, on Facebook, by definition, right? They are.
They're supposed to be.
And so that's a little bit. I mean, you're turning into a kind of a multi-level marketing scheme by pushing product on your friends, and those generally don't work out too well. But I'm sure it's a very small marketing investment. So it's hard to criticize a company for experimentation.
How would you feel about Jason if he tweeted you a deal? Like, would that impair your friendship?
Yeah. I mean, because you think about it, if you think about sort of the math equation of it, it's like Jason basically assumes that my time is worth nothing, but he's worthy to he would appreciate taking advantage of my time in order for his own personal benefit.
gain.
But if
Yeah.
I was tweeting him a deal about basketball shoes or perhaps a beer that he likes,
But you can't tweet it.
Then
you have to
at least it
tweet
maybe
en masse,
takes on a
right? You have to
personal
tweet the same
dynamic
deal to
there.
everybody. You can't target just a specific person. To
well,
tweet.
I imagine. Well, I
Yeah.
think you would actually have to direct that tweet to that individual. Yeah, but you can in theory do that. But I'm just saying, like, if it was a basketball shoe or a beer that I know he likes, otherwise I might not direct it his way.
This is probably a good time to mention you can follow us on Twitter at Motley Fool Money. Coming up, if a big asteroid is going to hit our planet, shouldn't we at least figure out how we can profit from it? Stay right here. You're listening to Motley Fool Money. Welcome back to Motley Fool Money. Chris Hill here in studio with Jason Moser, James Early, and Tim Hanson. Let's hit the beverage companies, James. Coca-Cola's fourth quarter profits up 13%. Pepsi's fourth quarter profits up 17%. And for a number of reasons, it looks like Pepsi's doing a little bit better lately.
Yeah, they are doing better. Pepsi had been focusing on healthy stuff for many years, Chris, until it realized that people actually don't want healthy stuff. They
Yeah,
want
that's a
junk.
mistake.
So it went back, it re-embraced its junk food roots and just sort of went to the bad side. It kind of reminds me of when Hulk Hogan became a bad guy wrestler, if you remember those years, which, by the way, you're looking at me, it appears you don't. But
No.
yeah, he became a bad guy. Pepsi did surprise Wall Street, 5% organic revenue growth, 1% drop because of foreign exchange. But profits were strong across the board, sales gains, organic sales gains in all its categories. So it's doing very well. Coke missed expectations. Not quite as good. Weak in China, weak in Europe. Still having a decline in North American sodas. I think they're both companies are solid long-term investments, but they're both priced a little bit richly right now.
How big a threat is the whole obesity discussion in the United States if, when you look at these companies, in terms of revenue, most of their revenue is not coming from inside the United States?
That's True. North Americans' soda volumes, even now, are still going down. We're drinking less Coke and less Pepsi, but it's still a material chunk, and it's something that can spread worldwide. I mean, other countries are trying to now cut back on cigarettes, for example, and they're going to start cutting back on the junk food that we're exporting. I mean, they're seeing cancer. They're seeing the same American diet-type diseases that we've had that they didn't have at the rates they're having now.
I mean, but both companies have also sought to mitigate that by buying up substitution products. Coca-Cola has Honest Teas, for example,
Right.
and so to the extent that Coke consumption declines, they've got something else in the works that they can start producing and distributing.
Moving to the healthier side, Whole Foods first quarter profit rose 24%. Same-store sales were up more than 7%. And yet, Tim, good numbers, but not good enough when you consider the stock fell 10% on Thursday.
I think Whole Foods investors, and I'm a fan of Whole Foods as the company. I think it's a great grocery store. Having said that, Whole Foods investors need to look in the mirror and remind themselves that it's a grocery store. It put up 7% comps. It has best in industry profit margins. They're opening 35 new stores next year. By all measures, this company is operating fantastically. And the stock was down 10% and probably arguably has another 25 to 30% to go before it's valued like a great grocery store. I mean, I don't know what Whole Foods would need to do to justify its valuation. I mean, it would need to do something wild and crazy, but it's just a grocery store, people.
So you're waiting for more of a pullback.
Yeah, I mean, it's like, people obviously put a premium on greatness, and so Whole Foods should trade for more than Walmart, Kroger, Harris Teeter, these types of companies. But you're not ever going to get 10 to 12% operating margins at a grocery store. It's just the business doesn't work that way.
Fourth quarter revenue for Buffalo Wild Wings rose by 38%, and same-store sales were up nearly 6%. Kind of an interesting week for the stock, though, Jason, when you consider that, on those numbers, again, good numbers, but not great, stock fell, but it looks like it's basically flat for the week.
Yeah, it was a good quarter and a good year, really. I mean, they passed the $1 billion mark in sales for the first time this year, and they continue to grow the concept there. They're going to be opening up their 900th restaurant, I think, next week, they were saying. It's interesting to see that Sally Smith there sees a market for 1,700 of these stores. I'm not so sure that's a realistic estimate. I feel like it's a little bit robust, but they are facing some genuine headwinds in chicken wing costs and labor costs and even beer costs. And so really you're seeing the restaurant level cash flow really getting crimped from those costs. And they're trying an interesting new little test out here in a number of restaurants where they're testing wings by the volume as opposed to quantity. Normally you would go in there and you'd buy 6 wings or 8 wings or whatever, but instead they're saying, well, chicken wings are bigger now. The chickens are bigger for whatever reason. So instead of 6 wings, you might get 5 because it weighs about the same. Now, I'm not sure how well that translates to the consumer. It'll be interesting to see sort of the results from this testing, but I think that's what they're facing right now. That's sort of the trepidation there on the stock, but I feel like at least you're buying into a good leadership story here with Sally Smith. She's been there since 1996, and she's dealt with this kind of thing before.
Growth hormone adds to the flavor of this.
As a third-party observer, I'm not too familiar with Buffalo Wild Wings, but all those kinds of like surreptitious price increases where it's like, hey, we're not going to change the price, but we're going to change the product.
Right.
That always seems a little bit customer unfriendly to me. Like it doesn't.
Well, I feel like it'd be customer unfriendly if you said, hey, I want 6 wings. Well, no, we're going to give you 5, but they weigh the same.
Well, and the thing is, when you go out to buy wings, right, you're in a group and you order the number. You're like, all right, everybody's going to have 6 wings. There's 8 of us. We need 50 wings, right? It's like, do the math on, all right, we're all going to eat.
You got these odd numbers.
1/3 of a pound, which is
Fractions.
like 5 ounces-ish.
We got about 30 seconds left. We dodged the bullet, and when I say we, I mean the planet Earth. The asteroid that was hurtling towards us missed us by about 17,000 miles. But it seems like we got to come up with something to stop these in the future. If you're betting on a company to come up with, a device to basically knock these things out of the sky.
I'm going with Elon Musk and SpaceX. Put some lasers on those things. We solve this problem.
Jason?
Certainly there's got to be something out there that 3D printing can do.
James?
Chris, I've been doing some research, and apparently shooting a nuclear missile will not work, scientists say, but they do recommend trying to paint the asteroid as quickly as possible because the absorption or refraction of the light might change the asteroid's trajectory by a few degrees, so I'll go with Berkshire Hathaway, which has millions of more paint.
Or maybe they can partner with SpaceX and put paintbrushes instead of lasers on those spaceships.
Brilliant ideas, one and all. Guys, we'll see you later in the show. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. I'm Chris Hill. Joining me in studio once again, James Early, Jason Moser, and Tim Hanson. Before we get to the stocks on our radar, I should mention you can always drop us an email. radio@fool.com is the way to get a hold of us. radio@fool.com. Drop us a note. Ask us a question. Weigh in, particularly if you have thoughts on how we can stop asteroids from destroying our planet. Let's face it, Tim, we need all the help we can
That
get.
sounds like a White House petition.
I'm not looking to involve the government. I'm just looking for, just citizen action. You're up first, Tim. Stock on your radar this week?
I'm looking at a TD Ameritrade, which is a discount broker. They released their January sort of account activity metrics. And, assets there continue to rise, as you'd expect, in a rising stock market. Investors are getting a little more active again. They're doing some investor education, and they're sitting on, a lot of cash balances in their accounts. It's like a bank in some ways. So if interest rates do start to go up, they'll earn a lot more in interest income. So I think there's basically two kickers there. One is more activity in the stock market, more bullishness. People trade more. That's good for them. And then interest rates maybe start to go up as the economy improves, and that's good for them too. And so they could be making a lot more money 3 years from now than they're making today.
And the ticker?
AMTD.
Jason Moser, what do you got?
I'm going to go with National Oil Well Varco. They just reported their quarter here, and while it was a good quarter, the stock pulled back a little bit. It looked like there were some margin concerns there in their rig technology segment of the business, which is their biggest moneymaker. But with that, they reported a lot of new business, some growth in the backlog, growth in new orders, which I think portend an active 2013. And to top it off, James's Asteroid killer, Berkshire Hathaway, keeps adding to their position. So I think when you see Buffett buying a stock like that, you might want to take his cue.
Do you know it's Buffett? I mean, there are a lot of guys now pulling the strings.
I guess that's
there.
a good point. That's a good point.
James, what do you got this week?
Chris, Waste Management is a trash company. It's an income investor recommendation. It has been
Also a Berkshire Hathaway holding.
delivering mildly disappointing results over the past several years, let's say. And it just released another batch of mildly disappointing results. But at some point, the mildly disappointing results have to stop. Construction volumes are down, and that affects trash volumes more than people might think. But this stock pays a 4% yield while you wait.
So mildly disappointing. It's not woeful, though.
It is not woeful. That is a very well put phrase, Chris.
Wow, is TD Ameritrade also in the Berkshire Hathaway holdings as well? Because they're out in Omaha.
They are out in Omaha. I do not believe they are a Berkshire holding.
You're the outlier this week. I'm sorry.
I'm sorry. I can go back and look for a Berkshire idea.
I didn't know we were going to have a theme. All right, James Early, Jason Moser, Tim Hanson. Guys, thanks for being here.
Thanks,
you,
Chris.
To read more from Tim, you can go to foolfunds.com. That's going to do it for this edition of Motley Fool Money. Our engineer is Steve Broido. Our producer is Matt Greer. I'm Chris Hill. Thanks for listening. We'll see you next week.